Hello, everyone, and welcome. Okay, I am super pumped about today's panel. If you are watching this, you are here for the Show Me the Money panel. We're going to talk all about what you need to know about how to raise capital and ultimately everything you need to know about funding. My name is Asia Arangio, and I'll be your moderator for today. We have a lovely panel of just incredible wisdom and talent and experience, just deep insight about not only the Atlanta industry and when it comes to capital, and then of course beyond. So we're going to dive into all of the fundamental questions that you have. If you are here watching this today, please enter your questions into the stage, and depending on if they are if they are exactly what we're kind of looking to dive into, we'll absolutely ask those questions. And I am going to kick off with introducing the panelists today. So Karen, if you could please introduce yourself.
Hey everyone, my name is Karen Houghton, and I am Vice President at Atlanta Tech Village. And Atlanta Tech Village is America's 4th largest tech hub. And I'm also a venture partner with Atlanta Ventures. And look, I can see the sun coming in down on my face right as we did this. So I'm going to change this because that's driving me nuts. But I'm really excited to be here with you guys. Virtually, of course, we get to have this stuff with lighting and family, and everybody's navigating lots of different things at the same time. But excited to be here, and I'm excited to have a good chat with everybody.
Awesome. And then can we move over to Charlton?
Awesome. Hey guys, it's Charlton Cunningham. I currently serve as the Ecosystems Program Manager at HBCU VC, a nonprofit organization that's trying to bring more ethnic and racial diversity to the venture capital space. You might know me from my work at Startup Atlanta. That's how I know the other great folks on the panel. Super excited to be here. It's always weird doing these events where I can't see you, but I trust that you're there and that you'll be engaging, and I'm excited about the conversation ahead.
And the lovely Jennifer.
Hi, everyone. It's great to see everybody. I am Jen Bonet. I am a recovering tech entrepreneur turned ecosystem builder. Done about 7 startups, 3 of which were tech-funded, venture-backed entities with exits. That was a long time ago. I spent most of the time, the last 12 years, focused on ecosystem building, first in Atlanta through Startup Chicks, and eventually ATDC, the Advanced Technology Development Center at Georgia Tech, the state's technology incubator. And 2.5 years ago, I moved to the lovely Savannah, Georgia, where I'm coming to you live today to focus on how to build a tech ecosystem and in Savannah, Georgia. And on top of that, I'm also raising a seed fund, so I can talk a little bit about that.
Awesome. Thank you so much. Okay, really quick because I, of course, just realized I did not introduce myself. Hi, I'm Asia. I am the CEO and founder of Demand Maven. We work with early stage SaaS companies and startups on reaching the very first growth milestones. And my own personal background and experience has primarily been in SaaS and startups focused on growth and marketing roles. And just recently, I actually joined the board of Moz. Okay, so we are going to dive right in with one of the very first fundamental questions, which is, should you or shouldn't you? How do you know if it's time to raise capital? What is the ultimate litmus test for raising capital? Let's start with Charlton.
Wow, starting with me off first.
Yes.
So should you or shouldn't you? It depends on what type of business you're building. Are you building a scalable business, a business that has high growth, a business that's able to be 10x or 100x? I think those are the questions you need to be asking in terms of raising VC funding. So I mean, you really have to ask yourself the question: what type of business do I want to build? Where do I see myself in the next 10, 20 years? And so you really have to look internal and answer those questions first before you kind of get there. But I'll swing it over to my other panelists because I feel like they have some more tactical insights that they might be able to provide.
Let's hear from Karen.
Yeah, I agree with Charlton, and it's It's kind of interesting when you think about it, because at Atlanta Tech Village, we interact, and with Atlanta Ventures, we interact with, hundreds, if not thousands of entrepreneurs, and everyone's first thing pre-product, maybe their idea stage, they don't even have anything sometimes. And they're like, how do I raise money to make this happen? And I usually always say finding a paying customer is the best way to fundraise. And sometimes that's helpful. Often people are not amused, but it's true, because paying customers are the best way to actually raise money and have income. But the question often about venture capital is people assume that that is a natural next step. And most startups and most founders should probably not raise venture capital. As in, maybe your business isn't scalable in the same way. And once you're on that VC train, it's a hard train to get off of. There's a lot of expectations. There's a lot of pressure. There's a lot of people who start telling you what to do with your company. So it's just not the end all be all. And so usually, like Charlton said, and I know Jen will say lots of great things too, is an element of start with the foundation of you probably shouldn't raise money. And if you can all figure out how to do it without going to venture, maybe you can do some friends and family, maybe a little seed round. But if you're not ready to just scale and you don't have this hey, I'm going to make a 10x return for all my investors, which is incredibly difficult to do, you may want to stay away from venture. Not all ideas are billion-dollar ideas. In fact, billion-dollar ideas are very hard to come by, and that's what most VCs are looking for.
So I'm going to step in here. Everything that everybody already said, don't want to hammer in on it too much, but you've got to get a product, you got to get it out to the market, you've got to have some paying customers. You should not try and raise money, even from angel investors, until you hit those 2 milestones. But the other big one that people seem to have a challenge around is you really have to have a team. Right? You can't be a solo founder and go raise money, because if somebody else gives you money and you get hit by a bus, the odds of the company succeeding is very low, right? So there's really those 3 components, right? Build the product, get it to market, get some early customers, and have a team, and not just an okay team, like a team that can really lead this and take this to the next level if something happens to you, right? And then lastly, I agree. The other thing is it's, 10 times, 100 times, you got to be thinking really big to make these folks happy. You need to be willing to sell your baby in 5 to 10 years in order to have the exit that your investors want. So if you want to do this for the rest of your life, you probably shouldn't take capital from an angel or venture capitalist without the understanding. You do have a boss. The minute you take capital, you have a boss, somebody that you have to explain your decisions to, or potentially invite into the decision process, depending on how much equity they have. So,
absolutely. And eventually those people can unseat you as a CEO too.
Yeah, I have that going on with one of my most successful companies in Savannah right now. The board fired the CEO about 2 weeks ago, and it's really challenging right now. It's hard on the team. They are a 30-person company, so it's really hard on the team. It's really hard on the old CEO. I understand the board's decision, but in my role as an ecosystem builder, I now have to try and figure out how to navigate, help them continue to be successful, because I need that company to be successful.
Right. I absolutely love the grounded clarity in terms of, we need a product, we need customers, and ideally we have a team that can ultimately support this. For those who are kind of in that phase where they think that they might have $1 billion idea, but they're not certain. Is there something that you guys look for when it comes to this is a very clear indicator of getting funding, or is it it's a much more gray area? There's so much nuance that goes into that one particular focal point.
I think one of the things that we often look for is, are there 10 passionate paying customers? And that metric is not impossible to get, but it also is really important. And they can't be friendlies either. So if you're like, yes, I have 10 paying customers, but it's my spouse or my partner and my friend and my neighbor, then they're all friendlies who may do it just to support you, which is awesome. But you want like 10 unaffiliated paying customers who are passionate about your product, because that starts to lean towards, do you have product market fit or not? And that's kind of one of those first big steps. Like if you have 10 people all of a sudden who can't live without your product, there's going to start to be some natural growth from that. So I think that that's a really important metric too.
Also, like Karen mentioned, that it's not $1 billion idea. You go through the stages. And so she mentioned the product. So you go through the lean startup methodology. As you know, you're testing out your idea and you get to a point where you're looking for product market fit. And so it's really hard to figure out if you have $1 billion idea, but if you go through the stages of the process, you can begin to see, like, if you have that traction, the customers, hey, maybe I have something, maybe the product, can take off. And so kind of hard to figure out, hey, this idea is going to be really, really great without testing it out.
And pre-product and kind of even getting to that spot, you look at your total addressable market, right? Your TAM. So it's like, who is your TAM? And it can't be the whole world, right? So like whatever industry and sector you have, like be really real, and you can start working kind of your way down. So say, whatever that industry and sector is. And if you also say, I'm going to dominate and have 80% of that industry, like you're probably not. Like best case scenario, a really good healthy one would be like 10%. It doesn't mean you can't do more. It doesn't mean you can't be successful with less, but kind of looking at that market share and say, all right, how big is that potential market? If I were to capture 10% and they were paying this amount, like what would that look like? Is there room for more growth? Is there a variety of markets that you can kind of move into? But all those things kind of help you tell if it's $1 billion idea. And I think it's important to remind founders that it's okay if it's not $1 billion idea. A VC may not want to invest in you as much if you're not $1 billion idea, because that's what they are looking for. But as a founder, you have the opportunity to decide what it is that you want. And, there are lots of really, lifestyle businesses. I think people are like, oh, lifestyle business. I mean, you could be really successful with a lifestyle business. And that's something where you're making good money, you're employing people, you're supporting families, you're helping your customers. All of those are good things. So, you could ask yourself too, like, all right, if we are a 1 million ARR company, is that enough for me? What if I'm a $3 to $5 million? Like where is those metrics to where you can look back and define for yourself is it a success?
So I'm going to disagree with that. And not because I know that it's going to be $1 billion idea when I meet the entrepreneur, but there are a couple of people that I've met with, and I'll give you 2 examples of that in my time at ATDC in Atlanta, really involved in the ecosystem, that said from the get-go that this was going to be a unicorn, like this was going to be $1 billion business. And that is, Rob Froheim from Cabbage. From the very first time I met him, I didn't really get it. And he said, this is going to be $1 billion company, Jen. And I was like, oh, okay, who am I to... I don't know that space, but okay, I don't see it. And then the other one was Greenlight. I mean, most recently, just raised that big round that made them a unicorn. Tim and the team there were pretty much adamant from the get-go that they thought this, financial literacy app for kids was $1 billion business. And I mean, they were part of ATDC. Tim was an EIR while I was a catalyst there, and we did the Fintech program together, and I didn't see it, but they are today. So I think there are founders that come into this, look at a market and can say, this is $1 billion idea and I'm going after it. I don't know that I'm one of those people. And I certainly, as an ecosystem builder, when I meet those people, I may not always believe it, but I will do whatever I can to support them as an ecosystem builder. And I think that's my job.
But those 2 are really great examples. And like, you can even look at Calendly, like they're going to be a unicorn, right?
Yeah.
they are, but it's one of those elements of like, look at the total addressable market, right? Who wants to schedule meetings? Pretty much the globe, right? I was like, don't say that, but the element, like when you look at the growth of who that is, that's everybody. When you look at parents, the number of parents in the world whose kids eventually have to have some kind of financial ability to learn about money. And so that's where you kind of look at that. Like you want that kind of clearly defined niche, but if you really want to know, do you have $1 billion idea? Like who are you selling to? Like how big of a market is it? And that's when it's exciting. And then like to somebody, I think in the notes, they were just like, yeah, you got to like dream big. And some people think bigger than me. Like I work with David Cummings. He thinks bigger than I do. He thinks bigger than I think most of humanity does. And I love it. And it's super inspiring, but you want to kind of make sure that it's real, you know?
And know that each of these entrepreneurs that we've just talked about, it's been a 5+ year journey to get to where they are.
Yeah.
So it does take time. It does take passion. It takes that perseverance to get through the early stages, to get that early product to market, to raise a little bit of capital so you can raise more capital later. There's a process to it. But I have to say that there's a lot of people I've met that dream about $1 billion businesses and make it happen in Atlanta.
Mm-hmm. Something I would love to clarify for the audience, and also just to kind of get everyone's perspectives on, is how much when we say VC money or venture capital, how much, like what is that number? And then comparing that to just early investment rounds. So I would love to just hear, like when we say venture capital, like what kind of numbers are we talking?
It's changing and it's different in different regions. So in Savannah, it would be a lot less than it is in Atlanta. But I mean, today we're seeing like up to $10 million seed rounds, which typically, a Series A, the first real venture capital round would probably be 2 to 10 million, but we're seeing significantly larger Series A. And then the seed round, the very first round, kind of after friends and family, would typically be, before was like up to 2 million, but we're seeing $10 million rounds right now. So I think it has a lot to do with the economy, the ideas. I'm not in Atlanta, so I'm not watching the deal flow as closely in Atlanta as I once was. So I'll turn it over to some of the folks that are there every day.
Yeah, East Coast, West Coast, there's a big difference. And it's like anytime, even I've been like, all right, so how are we going to define this? Like what? I want to put a box around the terminology so everyone's on the same. There's not really. It's so if someone acts like they know that there's this perfect little amount, it's not. It's, to Jen's point, like seed range to Series A, Series B. I mean, Series A, probably East Coast would start 3 to 5 million. West Coast, maybe it's 7+ million. Ask again in 6 to 12 months, maybe it's different. But, and it also depends, like even a seed round, they are often smaller amounts of money. Like a seed round could be $250,000 up to $3 million. And who you're getting that money from depends on what their kind of desire for that return is. But just think about it, the more money you're getting, the more pressure there is to perform and produce a really solid return for your investors. And that's when that pressure kicks on, which is good, right? But it's like you want to use that kind of venture money to fan the flames of something that's already like kind of starting to go. And you want it to help you scale quicker and faster and get there as soon as you can, depending on your product and the market and everything that's going on. So think about it as fuel to the flame instead of creating the flame. Like you already need the fire there, and then you want the venture to help get you there quicker and bigger.
Absolutely. Charlton, what kind of numbers?
They hit it on the nail on the head. I mean, obviously the West Coast, you're going to see the larger numbers. The East Coast, maybe Boston will have kind of similar numbers to the Valley, but for the most part, you can't really go by rounds. You have to ask them, what numbers you're looking at. And so, yeah, I agree with exactly what they said. I can't really add anything to it.
And often we'll start with like, you're probably going to ask Stacia, I don't know if I'm skipping ahead, but like the friends and family round. I know I work with some diverse founders. I think actually all of us do. And I don't have a lot of rich friends and family. And so it's like, hey, cool. I'm glad you just raised $1 million from like your friends and family around, but like, who are these? How do you know these people? And what if you don't have that community around you? So I think sometimes that terminology can be really off-putting or misleading. Sometimes it literally is they have the gift of having this network and this background to where they can access capital. It's really common out in Silicon Valley, right? You just have an idea on a napkin, you got a reputation and network, and you can raise it. And there's truth in that. Atlanta is certainly very different. We're a little more cautious with writing those checks. There's a lot of really creative ways that you can access that capital. And it's not that it has to be somebody you already know, that there is a vast network of angels and other folks who will write those smaller checks pre-product if you need to, that will help kind of get that going.
Right, exactly. Charlton, something that you said, and this I think also kind of falls under this litmus test of like, should you or shouldn't you? But something that you mentioned earlier actually had to do with traction. And like, there's the obvious, like, let's assess our product market fit. But as we start moving closer into traction, this can also be a very clear sign of, okay, now it might be time to consider raising funding. I would just love to hear from everyone, what kind of traction, what kind of growth rate could indicate that this could actually be a great opportunity to add capital to grow even faster?
So I'll mention one thing that founder friends of mine that I've mentioned. You might want to look at, you can look at your month over month growth, but you also want to look at your churn rate. So how often are the people who are buying staying with you? So that can let you know that the lever for growth, if I, as Karen said, add fuel to the fire, that I know that I can continue to grow, but also be able to keep them. So that's an interesting metric to look at with the month over the month growth is how often, what's my churn rate and how often am I losing the folks that are, the new customers that are coming on.
Absolutely. It's like that stickiness, right? So if you're onboarding 10 new customers, but 3 months later, you've retained 3 of them, then it's not very sticky and there's an issue with your product. So I think that month over month growth, year over year, but really we're looking at month over month, right? Depends on what season your company is. So it's like, how quick are you scaling? How sticky is your product? And as long as you can keep that churn rate down, that's what you're kind of looking for.
Yeah, absolutely. Jen, anything to add to that? Are there any particular growth metrics or anything like that you look for?
Yeah, so you want to also look at the customer acquisition costs, right? If it's costing you more money to acquire customers, then, the lifetime value of that customer is going to be, it's just never going to work, right? So I think there's, lifetime value of a customer that has to do with how long somebody's staying with you and how heavy your churn is, right? And then what's the, cost of acquisition. And a lot of people come in and say, oh, it's going to be free because, they're going to find me on social media. Well, that doesn't really work. Social media doesn't really convert. You can probably tell us more about that, right? Demand marketing. But so, you need to have a solid plan around that. And you have to really understand those numbers to understand whether or not you can truly scale.
Exactly. This is actually a perfect segue into really the next portion of this discussion, which has everything to do with what is the right kind of funding. So we kind of talked about the, should you or shouldn't you? We covered what are some of the litmus tests that we ultimately look for. But let's also, there's just so many different options when it comes to funding. And there actually is a question from Jay, which I actually think is another perfect segue. But are accelerators the best way to raise capital or to get funding to build what's needed in tech to scale to the next level? So I think the ultimate question is, are accelerators really the best way to start to raise capital? But then also, of course, my guess is we'll probably get into what are some of the other different kinds of funding and different ways to raise capital.
So I'm going to start to say that every time I've eventually raised capital, I've paid myself nothing for about 18 months before we raised capital. So you have to have figured out how you're going to live while you get your company off the ground. And there's never been a better time for that, right? When I did it, there was no Uber, there was no Lyft, there was no DoorDash, there was no Airbnb where I could rent out a room. None of that existed. I did get a roommate. I did downsize my car. I've done all those things. I've been able to use one startup's proceeds to fund the next startup idea. But I do think, this is a long road, right? And so you have to have a plan for funding your life while you work to get to the stage that you can get funding. And you want to do it with things that don't take your mental capacity, is my coaching to most people. Is if you're doing a day job that just really requires all of your brain power to go towards that, working on your side hustle, your startup at night, you're not going to have the energy or the mental capacity to really have an impact on that. So I think that's important.
And as far as the pre-accelerators, I would say they are an option. They are a way. They are not the only way. So at Atlanta Tech Village, we have a pre-accelerator. There's accelerators. We have Techstars in Atlanta, obviously. Shout out to Techstars. So there's a lot of different paths into that. Accelerators can be really beneficial because it is like an insane focused boot camp of three months, 4 months, depending on the program, where you get so much knowledge, you get an incredible peer support, you get direct mentorship, and it's like you're drinking from a fire hose, and hopefully they help you get to the next level. They also have a great network. So I think that's Techstars is known because if you're in a Techstars accelerator program, there's an immense network available to you, as well as some prestige. What you have to remember is that you are giving up part of your company. And different accelerators have different amounts. Like I've seen, hey, you're going to give up 20% of your company for 50K. Or like you have to, there's all sorts of variables and everyone is different. So I would just say you have to look at your company and think, is this amount of money going to make such a difference? And is it needed so much that A, it's going to move the needle forward and be worth you giving up your hard-earned equity? Or B, will the network and the resources available to you make that sacrifice worthwhile? Which it absolutely can. It just depends. And then I think the other option is, are there places or ways that you can get all of kind of that same or similar network and resources where you don't have to give up equity? And that's a little shameless plug for Atlanta Tech Village. But I often see that, and like founders will come and we refer people to accelerators all day long. We have a pre-accelerator that is for diverse and underrepresented founders. So I'm always like, hey, there's a lot of programs out there, but you can come get mentorship. We can introduce you to capital. You can get all of these things, free membership at the Village, and we take nothing. It is 100% pay it forward, zero cost. It is free. And I'm like, why are more people not doing this? Like, this is an opportunity that we have. And then we'll refer out to pre-accelerators. But even just at Atlanta Tech Village, some people are like, should I do this? And I ask those same questions, like, what will the money do for you? Will it move the needle forward enough? What can they provide you that the Village is not currently providing you? Because we have workshops just like ATDC and ATV, and there's a lot of great organizations. Atlanta is so dense and vibrant in our ecosystem these days. So really think about the give and take, but they are a great option to have. And if you get accepted into one, you should definitely consider it, but do consider it carefully.
And I'll hop on that kind of the non-equity funding train. And so there are a lot of great free resources. And so is there a way that you can do pitch competitions to find some of that capital to sustain you while you keep going? Another great form of capital that not a lot of people think about is SBIR grants. The government every year gives out like $2.5 billion of equity-free grants, which essentially the government is your customer. And a lot of people think of the government and they think, it's military defense. I got to be Tony Stark, but the military basically has all they have all the civilian things that we have for themselves. And so there are a lot of opportunities throughout the government that you can, if you're working on something, that you potentially can find some funding. So there are a lot of ways that you can find alternative forms of capital where you don't have to give away a piece of your equity, and you can continue building your product to kind of figure out if you want to continue bootstrapping or that way, or if you may want to take VC funding. So there are a lot of resources out there. As Karen mentioned, Atlanta has a wealth of those resources. I know I saw Larry pop in the Startup Atlanta website. So definitely think through it, and consider all your options before you think that one thing is the path forward.
Right, because when you talk about bootstrapping, we hear that a lot, and it's like, oh, I bootstrapped, or you should bootstrap, and you're like, yeah, what does that mean? Where do I go? What do I do? That's what we all like. That's a very normal process to go. And so I always am like, hey, the first step is to look for free resources, right? Founders are scrappy. To Jen's story earlier, like I know a lot of people who are like selling their cars, pulling out 401ks. And maybe you have that privilege and maybe you don't. Maybe it doesn't, wherever you're from, there's opportunities to get free resources, whether it's through universities, through schools, through accelerator, like kind of hubs, tech hubs, if you will. But there's a lot of great things. I saw C. Whitehead, that was a really nice comment there about the village. And we have a startup summer school that we do every summer. It's like a startup boot camp. It's like 9 weeks. It's free. We even feed you free lunch, or pre-COVID we did. So there's opportunity. I think Asia, you taught that one of our classes in there too. Y'all, Asia,
I did.
The woman, she's amazing. So there's all these things. So look at doing that. Look at doing pitch competitions. Like sometimes all you need is a good idea and a really pretty deck and the ability to tell that story, and you can win free money again. So there's resources, there's grants. I would exhaust all of those first before kind of giving up equity. And then of course, everyone's like, well, how do I build the product? And Jen and Charlton, I'm sure y'all have some really good stories in here too, but it's always like, that's where you can start giving away equity. If it's like, okay, I can't pay a developer, and I know it is hard to find a good CTO who will build an MVP for you. So that's not like this magical, easy thing to do. It's kind of a unicorn too. But if you can find a good person, you can say, hey, I don't have salary, but I can give you X amount of equity to join this company. And you can grow that way too, which does not require capital upfront. So there's a lot of creative options, and entrepreneurs are resourceful. So y'all can do it.
That's how I got into this game. My first startup, I'm the chief technology officer that built the product for equity.
That is probably one of the most extensive, most concrete lists of all the different ways that you can get funding. So between grants, I just saw crowdsourcing from Amelia. So thank you for that as well. Pulling from existing resources in addition to applying for just some of the different like funding opportunities out there before you ever even think about giving up equity, which I think is incredibly powerful. One thing that we've actually talked about just in the preparation for our panel today was raising friends and family rounds. How do you find the rich friend? How do you even go through that process in the first place? And then also, I think a slightly different approach to that is how do you approach the angel investor? So someone who might not be the rich friend, but someone who could potentially give you that very first small round of funding. Talk to me about what that process looks like. Actually, I think we can start. Can we start with Jen?
Sure. Happy. So I will say my very first company, we raised $450,000 in friends and family. The key to success in that was that there was 4 co-founders. And if you play the Kevin Bacon game with 6 degrees of separation with 4 people, you get to a lot of people, right? And so we had a really diverse team, and we were able to just reach out and really pull together I don't know, I think we had 110 investors. Let's just put it that way. Okay. I think like we were taking $5,000 checks left and right. Now that is dangerous. There are ways to do that the right way. So if you go that route, talk to somebody about it. You want to form an LLC, put all those investors into the LLC, and that's one investor into your company, just to make it clean. So I think, having co-founders helps raise money, right? It does. It makes your bench of people that you can reach out to deeper. And now I think there's platforms online that you can post your company, either through more of a crowdfunding place or an angellist.co, or all these different platforms where you can post them online that didn't exist back in the day when I first raised money. And then there's certainly a lot more angel activity in Metro Atlanta than ever before. I know it's hard with COVID, but Atlanta Technology Angels, there's got to be at least 8 angel groups in Atlanta that are active and still meeting, because I get all the invites every month. So I think, reach out to the Charltons and the Karens and the ATDC Catalysts and Entrepreneurs in Residence, and they'll make introductions when they feel you are ready, is one of the keys, right? A lot of times they're not going to make an introduction until you're ready. And part of that's because some of our investors have long memories. That's all I'm going to say.
Yeah, I think having a warm introduction is obviously ideal. So you can LinkedIn somebody with your request. Sometimes it works. I would say it usually does not. But when you do reach out, if you can get a warm introduction, I think you just need to have really short, sweet, I'm going to go really practical for you guys, but don't do the really, really long novel emails, because no one will read it. It's not a good use of your time or their time. Attach your pitch deck. If you don't have a beautiful pitch deck, do not reach out to anyone yet. And just kind of make it as personal to them as you can. Like if you were going to reach out to Jen, you should know that she lives in Savannah, and you should know that she used to be ATDC and that she's had this, and compliment her, right? None of us are afraid to do this, but you just say, hey, I really respect how you did XYZ. Because when you are entering into an investment relationship with somebody, it's like you're in a dating relationship for the life of your company. So you're stuck with them. And a divorce with them is super messy and no one wins. And that's why a lot of startups fail, whether it's through co-founder relationships, investor relationships. So you also don't be so desperate for cash that you are willing to kind of sign with somebody who's not a good fit. And I always say, again, I'm biased, but connect with somebody like an Atlanta Tech Village. So when you're on your own in your basement or in your home and you're building, that's great. You do you, it saves money. There's a million practical reasons why that's a good thing. And if you already have an established network that you can reach out to, that will not hinder you. But if you are not yet known and you don't have a well-known reputation or brand that you have built for yourself, it's like you're kind of unknown and it's a lot riskier and you're not relationship connected with somebody. So that's where getting connected with anybody on here, anybody in the ecosystem, and you start showing up and people know you, all of a sudden those warm introductions are a lot easier and you're connected. And there's a little bit of Atlanta Tech Village, we have an application process. So if you're in there, we've done a certain level of due diligence, and then we get to know you, and then we watch what you're building. And as we go, then we would make an intro when or if we thought you were ready. So get connected. And the easiest way to get those warm introductions is to plug into a network. And I think all of us on this call here are hey, the more known and respected you are in whatever work you're doing and the better work that you do, then your reputation precedes you, and then fundraising becomes a lot easier. And so there's definitely an element of who you know, but it doesn't have to be about I know the most important people. It just has to be to the people who know you, respect you, and trust that you can do good work. And I think that's how you start building that network.
Yeah, so I'll +2 to both of what they said. It's a very relationship-driven process. It's about networks. I had a conversation with a an investor or a founder and investor who started Exact Target, and he told me a story about how he used to look in his neighborhood. Whoever had a pool, that's how he decided that was the rich person, and he knocked on their doors. But a lot of times you can look in your own community. So I know Barry Gibbons, when he was building his company, he had a lot of relationships with athletes. And so those are kind of his angel investors. And so you can kind of find the folks in your community that are a little bit closer to the capital than you are. And then, as Karen and Jennifer said, just through those relationships, through those networks, you begin to kind of build out a bigger kind of family friend network, and kind of can find those early checks. And so it's, when they say your network is your net worth, they're not lying about that. So
I guess one other thing is, when you start meeting with these people, you don't start with money. You start with, can I get some advice?
Yes. Because if your ask is to be like, hey, will you look at my pitch deck and what metrics do I need to hit? Or are there areas that are clarifying? Or what would it take to make this interesting to you? Any insights into industry trends or the market? That allows them to help you, and it allows you to receive advice and to get better. And it comes across like, again, think of dating, not to make it weird, but like it's an element of like you're getting to know them and they're getting to know you. And, it's better than just coming in with like, cool, I want $500,000. You're going to be like, cool, I don't know who you are. Like, let's talk.
Yeah, they don't want to write you a check if you're not going to be willing to take their advice. So if you start out by asking for advice and taking their advice, then you're starting to build a relationship that is the type of relationship that they want with their investees, the companies that they invest in.
And even if you're an amazing founder who's working really hard and has a great reputation, maybe your idea is a really good idea, but it's not a great idea, right? I think that's where a lot of us fall too. I've had a lot of good ideas. I haven't had a lot of great ideas. So there's an element of like, how do you figure that out? And I think that's where you have to be teachable, and then go back to the very beginning of thinking, okay, is this a venture idea and do I still want to pursue it or not? Yes or no? And there's no wrong answer. You're the only one who knows that. But I think give yourself permission to receive feedback and then allow it to influence or not influence, depending on your choice of kind of what direction you're going to go. Because you'll meet with 10 VCs and 10 VCs will probably tell you 10 different things. So, right? Because they're people too. So it's an element of like, the more conversations you have, ideally you can start to pick out, hey, I'm seeing similarities in this, or I'm seeing concerns from several people here. And then you can start to kind of pull those out as well.
This, with every great network, also comes a landscape. So from a current funding landscape perspective, how do each of you view the landscape today, especially in a post and also present pandemic world? And then looking forward, how do each of you just view the overall capital investing landscape today? Has it increased? Has it decreased? Has it also been incredibly nuanced based off of industry? Would love to just hear from everyone across the board on what the landscape looks like today. Actually, let's start with Charlton this time, if we can.
Sure. So kind of my thoughts on the landscape, as far as kind of the VC landscape, we are in a position where there are new funds starting, but there's also new funds closing. And so I think we're in a pretty good position. If you want to go to like what Crunchbase or what, the pitch book says about Atlanta, they say we're a mature VC ecosystem. And so that means that there's not really high jumps in terms of the amount of capital that's deployed in the ecosystem. Is pretty standard year after year. So Nashville is still having some really big years and really small years. And so they say that we're mature in that sense. But I would say from, just thinking through COVID, there is a lot of money there are still people raising their funds. There's still a lot of capital that needs to be deployed. What's, great about VC funds is that they raised all their money and they still need to give away that money, even though we're going through this tough time. I would say also there's a lot more diverse fund managers that are, starting to come on the scene. You see Collab Capital with Jewel, Justin, and Barry. You see Zane Venture Partners and Shyla there. So there's a lot of great momentum, I think, happening. New funds like Overline, Outlander. So I feel like we're in a good place. I would like to see, more. We would all like to see like more, more deals being had and more investments. But generally, I have a very optimistic outlook on where we are. We just need to keep seeing more of it.
Yeah, 2020 is tough, right? I mean, across the board, either the majority of folks, I think, are having a hard time. And then there's some folks that the pandemic has worked in their favor. And then, of course, there's a lot of us that are just lucky to be staying true and being able to close deals, but maybe not as quickly as they would have hoped. So like all of us, I'm ready for the year to be over. But in the positive side, for sure, to Charlton's point, the money is still there. The money didn't dry up from investors. They're just going to be a little more cautious about when they're going to deploy and who they're going to deploy that to. Like, is your startup pandemic proof? Is the pandemic kind of how it's shifting humanity a little bit and how we do things? Are you on track? Can you pivot to try to capture that? So I think there's a lot of opportunity, right? Challenges breed innovation, and this is where entrepreneurs often thrive. So be thinking long-term about kind of that approach. So it's tough, but I mean, Rigor was acquired for quite a hefty sum. I know Bark closed a large raise. There's a lot of folks that I could name who have been successful in raising, but where they had hoped maybe to close in March or April, they were closing like several months later just because of certain delays. So it's just 2020 where, it's all over the place a little bit.
So I'm really optimistic, right? So on a national level, what we saw Q2 and Q3 as COVID hit was most VCs made add-on funding to companies that they already invested in. But we started to see near the end of Q3 was VCs investing in new companies, which they met during COVID. So that's interesting. It's a new way of working, right? You can get on a Zoom call with somebody in California as easily as you can do with one in Atlanta, right? So that opens up a market that was harder before. You used to take trips. I used to take trips to San Francisco and spend weeks there to meet investors, and now you can't. So it's an awesome opportunity. The other thing I will say is I do watch, this is going to sound really nerdy because it is, I watch the Reg D form filings on the SEC website. So there's a website that I can go and I can click on, and I'll put it in the chat. It's formds.com. You can look at who's just raised money and reported it in Atlanta. And so when I look at that list of who's raised money in the last 2.5, 3 months, it's mostly funds. So that means we're going to have, as these funds collect that capital, they're going to need to deploy it. So there's a lot of capital that's coming into these funds. BIP's raised the funds, Engage has, Tech Square Ventures has raised money. It looks like Switchyards has raised money. So it looks like there's a lot of activity right now where funds are raising money, which means we'll very shortly see them starting to make their first investments in these new funds that they have to spend money quickly in order to get the return that they need in a 5 to 10 year period. So I think you're about to see the floodgates open up for cash in Atlanta. That's my prediction. You can hold me to it.
Lovely. So this is a topic that I think that we are all incredibly passionate about, but let's talk about diversity. And what I love about this is, I mean, for those with eyes, of course, and who can see, we are an incredibly diverse panel today, which is really awesome. So we have 3 women and people of color, which I think is amazing. but I think that also kind of lends a very natural question about diversity. So when we think about diversity when it comes to funding, are we doing enough? Is Atlanta doing enough? And also, what are some of the things that we could look to improve?
I'll kick us
Who wants to
off.
start? Okay.
So when you talk about diversity, you can look at it in two things, especially when we talk about funding. We can talk about the entrepreneurs and the founders and the startups, and you can actually talk about who is investing, so the investors. And so, something that I'm passionate about and that I focus on in my role at my job is creating more investors of color. Because we know that if we can create more investors of color, that will create better opportunities for founders to receive capital. I know I read an All-Raise report that said if there is a woman who's a partner, they're 2 to 3 times more likely to invest in a startup team that has a co-founder that's a woman or has a startup CEO that's a woman. That goes to show you that people invest in kind of what they're familiar with. That's why a lot of Harvard and Stanford startup founders get funding from a lot of Harvard and Stanford investors. So we could do a lot more to increase the amount of investors of color and women investors in Atlanta. We still have a long way to go. If you look at who are those investors of color, who are those women investors, those are fund managers. They had to raise that capital themselves to then deploy it. And it would be great to see more analysts, more associates that are women that are of color in roles that are at already established funds. I think if we look to make that metric a little bit higher, that would kind of help increase that funding gap. And we're starting to see it. Shout out to Justin McLeod, who's an investor at Outlander now as a partner there. And there's a couple other folks at that on that team as well. And so you're starting to see it come on. And as those funds I mentioned get more established, you'll start to see hopefully that shift. And also shout out to Valor Ventures, what Lisa Calhoun is doing. She has also brought on interns and folks of color to her team. And so we're starting to see it kind of over the last 12 to 18 months start to make that shift. But I feel like, and what I'm passionate about is increasing that will help the funders of color and the startups will help really close that funding gap.
Absolutely. One of this is really a brag on Atlanta Tech Village, but one of the programs at Atlanta Tech Village is It Takes a Village. And from my personal perspective, just being on the outside looking in, I am seeing Atlanta step up in so many ways when it comes to not just closing the funding gap, but closing the education and the education gap when it comes to how startups work, how SaaS companies work, and then of course raising capital. And I think it's a absolutely wonderful thing. It makes me incredibly proud. I absolutely encourage more. I mean, I think so much more about education, and a lot of it too, I think happens even before certain groups even consider raising capital. So much of it is just having the education about the opportunities that are available to them even before they start the journey. That knowledge gap, closing that also is just a critical part of the formula. But thank you so much for speaking on that, Charles, tonight. And just from my perspective, I see so much progress being made in that direction, and I'm excited to see more. Anything for Karen or Jen to add to your own experiences or observations?
You want to go, Jen, or you want me to go?
Why don't you go?
I mean, Charlton both of y'all spoke very clearly into that. And there's an element of when we first started Atlanta Tech Village, we had 3 white male co-founders, all good intention. And I was the first hire there. And so as we were going, I was like, oh my gosh, it's like all guys and we're all white and like, what's happening? But you just had natural communities. And so as we were growing, we chose to make a very intentional decision to do whatever we could to change that. Because that's a national demographic often in tech, but that's not Atlanta. And so I came back actually from like a Grace Hopper conference, which was like, God, so actually Jen and I went.
Yeah, that's right.
And we had some friends sponsor us there over at Warner Media. And it was just this amazing experience. And I was like, okay, we know we're out, like, we know this is what we want, but what are we doing about it? And so for us, like our Startup Summer Boot Camp, which was free, our pre-accelerator program that's only for underrepresented founders, that was us kind of putting the flag in and saying, all right, it has to start somewhere, and this is where we want to shift it. And I'm really proud. It's not enough, right? But I think we've seen a large shift, in our demographic at Atlanta Tech Village, and where females and my Black friends and founders and other diverse founders, like we all are starting to feel like we have a place, or at least Asia, and you're a big part of our community. I hope you have felt that way. So I think we have a lot of work to do. And of course we can talk about, how much money is not being deployed to underrepresented founders and how mad that makes me, and I sit across from female founders and I've heard horror stories, there was a very successful female founder that I've told the story before, where she was expressing to me how these meetings with these venture capitalists, like she would go into these meetings and it would be all white men, right? And it was, how did we get beyond that? And she was doing her pitch, and at the end, one of the guys asked her, like, does your husband help you with your business? And I was like, what? Like, and this was like a year and a half ago. So, that's not the majority. And of course, I loved her response was, does your wife help you with yours? Which I thought was really badass. But there's an element, all that to say is it's getting better. It's not enough. We're not nearly there. But I think particularly Atlanta's got a lot to say, right? And I think that we're making a lot of strides in the right direction. And if you want to know who is friendly in the world for underrepresented founders, all you have to do is ask somebody in the ecosystem who's not a white dude, and they will tell you. So like Charlton knows, Jen knows, Asia probably knows, like we all know. And some of them are white guys, and they're great allies, and they are friendly and looking for solid founders, and it doesn't matter. So we have a lot of really good people, but I definitely think there's bias and all sorts of things that we have to work through to truly make it an equal playing field. But there are good ones out there, and we can all direct you to who they are.
It's so hard. I've been at this a long time. I started my tech career in 1988. So I've been a female in tech since 1988. So I've shattered some glass ceilings myself. I've been hit on by investors. I've had an investor think I was a secretary and I should get him a cup of coffee, and I was the chief technology officer.
I'll never forget that story. Jen told me that at Grace Hopper. I've retold your story to people too, not saying who you were.
And that's when having a really great co-founder ally male said, oh, she's our chief technology officer. You're meeting with her next. Let me get you a cup of coffee, right? And then he was like, there's no way in hell we're taking money from that firm, right? I don't care how much they want to give us. We're not taking that money. So having really strong allies on the journey the whole time has been really important. We're not where we need to be. That's obvious. And what I'm doing now, strangely enough, to try and fix the problem is I'm looking at high school and middle school. I spent all day Saturday with, I was assigned to 25 young kids in the Savannah region for Girls Engineer It Day. So it was 80% Black, a couple of Latino. And the idea is, how do we keep kids in STEM third grade through high school so that they have the skills that they're going to need for the jobs of the future, to build our future workforce, to ensure that they're engaged, to teach them both the coding or technical skills as well as the entrepreneurship skills, to have the confidence to be able to go and ask for $2 million for their company. I mean, there's a confidence thing there that has to happen as well. And so I think we have to address it in the schools and in school-age kids to really have a huge impact in the future. And so that's one of the things I've been working on lately.
I love that perspective of focusing on kids, teenagers, young adults, because so much of our perspective and so much of what we believe is possible and the opportunities that are available to us are really shaped and learned and embedded in those incredibly formative years. So I love the and also just teaching kids young business. I mean, that's kind of the it's a huge core value of mine, entrepreneurship in general, and I love that we're tackling it early. Okay, so I do have one last question for you all, and then I think we can probably open it up to questions if we have time. But so we've talked about should you or shouldn't you? What are the right kinds of funding for your startup, venture versus alternative sources? And we had an incredible list thanks to our discussion today. We talked about the landscape, diversity, and an incredible topic. The last thing is really all about the relationship between investor and founder. This is a big question. So in whichever direction you all feel compelled to go in, but how should founders choose the right investor partners? What are the red flags? What are the green flags? Let's start with Karen on this one, if we can.
All right, green flags and red flags. If they ask you what your husband does, that's a red flag. No, so let's see. I know I've used the dating analogy. You've heard probably the analogy of like, are they somebody you want to get beer with, whatever. But the idea is, do they respect you as a founder? Do they understand and support your vision for what it is that you want to do? And can they bring value to you? There is, what they call dumb money, and it's respectful. I don't know why that terminology comes from, but it's kind of like, hey, like, I'm not going to bring additional value, but I want to write a check. You go do you, and hopefully you'll make me a return. That can be really great, right? Because you're like, cool, let me do my thing, and I'm just going to go. But there's also, often what comes with money is the expertise and the network and the ability to introduce you to customers. So I think for me, I would encourage you to also look at what value can they bring to you, especially if like we're talking board seats down the road. Like it's like, all right, they could decide to usurp you as a CEO once you have board seats. And we're mentioning that's not super common, but it definitely happens. So are they somebody that you want to be in a relationship with for the next 5 to 10 years? And do you feel supported by them, and can they bring value to you? Some flags on that would be, I'm a like gut decision kind of impression person. So I always go with my gut, and it's whether it's your kid or your business or whatever, like it's like you kind of have that check in your spirit. And I would just say, don't value the money past whatever kind of your intuition and gut is. And I would also just say, look at who they've invested in the past. And I would do due diligence on them, just like they're doing due diligence on you. So talk to people that they've invested in. So, like if Charlton was going to invest in me, I would say, great, Charlton, I'd love for you to introduce me to 2 other founders who've worked really closely with you so I can get to know them. If he says no, red flag. If he can't follow through on it, red flag. But if he's like, absolutely, let me connect you, then you can talk to those founders and ask them about their experience with the fund and with you personally and the value they can bring. So I just remember that you get to opt in just as much as they get to opt into you. I could go on and on. There's a lot of just stuff, but I think those would be the biggest things. And if you get no's, I'm going slightly off here too, but like no's are super common. So don't be discouraged. I've often had people in my office that are just completely in the like trough of sorrow, right? Startups, everybody goes through the trough of sorrow, usually multiple times. And I'm like, hey, it's okay. Like, how many no's have you gotten? And they're like 7. I'm like, oh, you're going to get like 20 more before you get your yes. Like, hang in there. So just remember, like, I think Y Combinator did a survey, and it's in one of their blogs. I'd have to find it. But you're looking at Y Combinator, right? Which is like an echelon of a of an accelerator in the United States, right? So they have some of the best startups. I think they read that they averaged 50 meetings before they got their yes. So I say that not to discourage, but just to normalize and encourage, like, just because you're getting no's, that also just means you haven't found the right fit. So make sure that you keep going until you find the right fit of, I want to be in a relationship with these people long-term. I feel like they support me and they're not trying to tell me what to do, but they're trying to lead me along the path. I know I'm going a little long-winded, but like, I work closely with David Cummings, right? He's with Atlanta Ventures, has a phenomenal track record of successful investments. And often founders will want to meet with him to get advice. And sometimes they'll come back to me and they're frustrated because they didn't get advice. So he's so good at like leading someone down the path. But if you ask him questions, he's often going to ask you questions back. And they're very intentional questions. But the idea is that he's going to lead you to the right answer, or he's going to lead you to the self-awareness of what you should do. So if you ask him something really specific, he will. But there's an element of like, if someone's going in there and you're saying, don't do that, do this, without taking time to listen to you, that would be a problem too. What do you guys think? Jen and Carlton?
So I think, 20 visits is very optimistic.
Oh, I can't hear her.
Can you unmute?
Oh, there we go.
So sorry, I'm on mute. So I was saying, I think that the first time I raised money, it was over 77 visits before we got a yes, or a maybe. Or the other question is, if they say no, to figure out if it's a no, not now, come back later when you've done these 3 things, or is it a hard no? The piece of advice I want to give here is, the thing I want to know about an investor is, how are they going to react when I give them bad news? Because as a founder, CEO, I'm going to give them bad news at some point in the future. And so my little trick for this is, once I start building this relationship with them, even before they've invested, I ask them if I could send them a monthly email update, just like I would send to a normal board once a month. Just giving you feedback on what we've done this month, whether we achieved our goals. I want to talk to you probably at least once a quarter, but I'd like to give you a monthly update. Are you up for that? And they'll typically say yes, if they're at all interested. And so then you give them a monthly report, just like you would your board. Here's what our goals were. Here's what we achieved. And then always share bad news, and always make an ask. So, hey, this didn't go right. This is how we're thinking about fixing it. Do you have anybody that you can connect us to that could assist us with this, right? And the investors that you want to build a relationship with are the ones that help you on that bad advice, that can make connections, that stay engaged, that just don't read the email and throw it in their wastebasket. But you're setting a tone that you're going to ask them for advice on an ongoing basis, and they're going to participate actively with you in building this company, and that you're counting on their relationships, their connections, and their ideas to help you succeed. And that way you're training them to get bad news. So the first time you have to give bad news is not a board meeting where they've already invested and you're petrified, because you've already given them bad news all along the way.
And there's always good and bad news with any beginning company. So don't hide it, learn from it, grow from it, invite people in, and retweet on the investor updates. I'm a big fan of those. I tell everybody to do it. It invites people in. It's like your lead gen for investors. Even if you're not asking them for money, anybody who's interested or well-connected, you say, hey, do you mind if I add you? I'm on a lot of them, but I do read, and I try to comment back if I am reading it, so I can let them know. But that way, when it comes time to make an ask, they should already be familiar with your growth and what you're doing and what's going on. And to Jen's point, the good, the bad, the ugly. You don't tell them the really ugly. You just kind of tell them the not great.
All right. Charlton, before I guess we open it up to questions, any additions to what Karen and Jen said? So red flags, green flags, kind of sounds like a lot of it has to do with, is this someone that you can give bad news to and still like each other at the end of the day? But what are some of the other things, if anything?
Yeah, I think they covered it. They covered it all. And to go back to Karen's analogy, it's like the relationship piece. And I think Jen mentioned this earlier, but like you shouldn't be pursuing someone's capital before you've had a conversation and gotten to know them. And so it's through that process that you realize, like, do you really want to be in a commitment with a person? And so, yeah, as early as possible. And, even if you're not thinking about raising for another 6 months or 12 months, who are those people that you think, through your research, hey, these might be people interested. How can I, do your research really early on, through talking to some of their other portfolio companies, figure out, is this someone that I want to be connected to for, the life of my company? Those are the questions you have to ask yourself. But yeah, I mean, Karen and Jen always kill it. So.
Awesome.
Just trying to be like you, Charlton.
I was just been out a lot longer. You'll catch up.
I'm scrolling through the questions now, and I actually think we covered pretty much almost all of them. I think the only one that I don't think that we did cover was, we covered the accelerators one. Okay, sorry. There was one that I thought that we did not get to, but I actually think that we covered. This was the one. This is probably a very quick one. Any sustainability funds in Atlanta region, and not certain if that's ringing any bells, but any sustainability funds?
Points of Light used to have a fund. Do they still?
I think they might still do their Civic X accelerator. I think they have a fund attached to it.
Yeah.
I would check into Georgia Social Impact Collaborative. They might have, they have a good grouping of impact-oriented funds, and so there might be a sustainability fund in that collaborative.
Okay.
And I know someone dropped in the Startup Atlanta ecosystem report. That's awesome. And it has all the kind of different funds and everything in there. I forget how many when I counted, but there were so many, and some that I hadn't even been familiar with. So it's a really helpful resource.
Okay, perfect. And then any other questions before I let these lovely people go? Oh, we got a question from Billy Boozer. Hi, Billy. Is there a reason that founders should take capital from a Southeastern investor over a SV-based investor? Any strong feelings?
Yeah, I mean, I would start with Southeast. And I don't know that it's true anymore, but a year ago, I would have told you get local capital for your seed stage and go to the West Coast for your VC stage, or find add-on investors for your VC Series A stage. Prior to COVID, people wanted to see local investment before they would invest in you from not local, because they want to make sure that you're connected to the ecosystem and that you have the support here at home to grow a scaling company. It's probably less important in a COVID-19 and post-COVID-19 world, but it was, better. Actually, 3 years ago, if you didn't have any local investors, you wouldn't have been able to raise money on the West Coast and stay in Atlanta. So that's changed, but and yes, well, early capital is expensive. Right? The earlier you raise capital, the more expensive it is, not just in the Southeast. It also has to do with stage of business.
I think like, especially on a slightly different way to look at it is if you are passionate about Atlanta and the ecosystem, then the more, all ships rise with the tide. So if you can get a local investor, that your success will benefit them and they are benefiting you. And then I think it builds the community and kind of draws the community in as a whole. And of course, addition to Jen's point, but generally I always just say, hey, if they're good people, then take that money and run with it, right? Like if it's a good fit, I don't really care where it comes from outside of those kind of awareness of community impact. If you can't get it local, then get it wherever you can. Money travels. Yeah, I saw Jay.
Awesome.
Charlton, you might answer that question.
Is the RCIE a great resource in Atlanta? From Jay.
The Russell Center. Yes. So I would definitely check out the Russell Center if you haven't. Jay Bailey is leading the charge over there. Barunda Prince Jones from The Farm is actually there now. And they are kind of, newer to the scene. I think within the last 2 years over in the West Side. And so, yeah, they're definitely check them out. They have a space and they have programming as well. Karen mentioned that there are a lot of great programs that are focused on diverse founders. Shout out to Joey Womack as well. Intentionally Good, Goody Nation, WeWork Labs, ////. He's doing great things. So yeah, definitely check out Russell Center.
Awesome. Well, this was amazing. Thank you so much to this wonderful panel. I personally, I learned a ton. But I also hope that if you're still with us today, right here, right now, that you also took away just so many just incredible insights and action items, and also resources to go check out. There are quite a few links in the chat today. Just absolutely incredible. So thank you to Karen, Charlton, and Jen. Y'all were amazing. Thank you again. And we're gonna wrap up today. But thanks again, y'all. And I'm sure we'll all see each other on Twitter. There's some links in the chat as well. And yeah, any final parting words?
May the odds be ever in your favor. We can do it. Stick with it. The money is there. If you've got a good idea and you're getting paying customers, there's no reason why if you get enough meetings and work really hard that you can't grow it into something great. So we need more big successes in Atlanta. So keep at it.
And there's lots of great mentors available. So ask for help.
Yep.
Yeah. More than likely, the people you reach out to, especially in the Atlanta ecosystem, are willing to help out. So don't be afraid to ask.
Awesome. Perfect. All right. I think that's it. I think we covered it. We did it. All right. Thanks so much, y'all.
Thanks.
Bye.